Money market funds are a low-risk, short-term savings option that allow you to have easy access to your cash. Which on Fidelity, you're automatically going to be given a money market fund as your core position, so your uninvested cash is going to be earning interest automatically for you. In fact, the difference between two investment accounts, when you have a core position earning no interest at all, or a money market fund that earns you 5% of interest, say you just sold some stock and have $10,000 sitting in the core position of your account for a full month. With one account, you would have earned no extra money, meaning that inflation is theoretically eating away the value of your purchasing power. But if it were a money market fund, that means the cash you have sitting would have generated you an extra $42. It may not seem like a ton, but throughout the time of selling investments, holding cash for an upcoming purchase, or even just wanting cash sitting because you can reap a 5% rate, the benefit from understanding this can add up significantly over time. With that said, let's get straight to it by first going over what exactly are money market funds. Now, money market funds are a type of mutual fund that invest into short-term instruments like US Treasuries, CDs, and other debt securities issued by the government, corporations, or other financial institutions. And in my most simplest terms, a money market fund is a low-risk option for you to park your cash while still earning interest and being able to easily access your funds if you need. But it's important to understand the only place that you can actually use money market funds is through a brokerage firm. For example, one of the most popular money market funds on Fidelity is SPACs. And when it comes to it, you can see on Fidelity's page that there are three main types that are government, prime, or municipal funds. The most common one that you're probably going to be starting with as a default is going to be SPACs, and this is a government money market fund that has its top weight in the fund being repurchase agreements, government securities, and then treasury coupons. It's amazing because right now SPACs is yielding a 4.96%, which is actually net of expenses, meaning if you see an expense ratio, theirs is 0.42%, that is already included in that yield. And besides the core positions, which I'll cover on later in the video, you can also purchase money market funds just like a traditional mutual fund anytime you want on the platform. And because of that, money market funds are actually considered investments and not savings, so they're not going to be FDIC insured, nor are they going to be guaranteed to make you money. Now you can see right here that SPACs is earning close to a 5% yield, and it's been achieving that for almost a year now at that rate, which is really good, but not too long before that, you can see it was earning 0%. Now I will say, if you are one to have your cash in this core position, especially at times when it's getting 0%, you need to be aware of this, so keep an eye on it because you could be leveraging your money in much better ways than letting inflation eat away at its value. Now you're probably wondering, a couple years ago it was at 0% and now it's at 5%. Why is it so volatile? And that right there is because it is based on the market conditions at the time, with the biggest factor being interest rates. For example, no matter the market conditions, if the Fed were to cut interest rates, the yield you would be getting on a money market fund would also be expected to decline as well. And the same thing vice versa, because if the Fed were to increase the interest rates, the yield you'd be getting on a money market fund would more than likely increase as well. But like I said, that all depends on market conditions, and that is why as of the recording of this video, the money market funds are actually getting the highest returns they've seen since 2007. And although they are achieving the highest rates, you need to understand that with money market funds, they are not going to be a tool to build long-term wealth, but are more so just a convenient way for you to earn interest on uninvested cash. With that said, let's now go over exactly how money market funds work. Alright, so with money market funds, because they are a mutual fund that invests into US debt securities, they're going to be tracking a dollar value, and the earnings you're going to be getting from them are going to come in interest payments. Now on Fidelity's page, you're going to see that money market funds have a 7-day yield. That yield is going to be the average return over the previous 7 days, which is then represented as an annualized rate, meaning that the 4.96% would be what you would get after an entire year if the rates were to stay the exact same throughout the entire time. The reason for having this 7-day yield is for investors to have a better understanding and comparison between the performance of different money market funds. But like I said, the rates do change, and with money market funds, your interest is going to be compounded daily based off the balance you have in the account in that position every single day, and then you're going to get paid that interest on a monthly basis. So let's just assume you have one of the most popular money market funds, that is SPACs, as your core position that currently yields a 4.96%. Let's just say you sold $10,000 of stock and you wanted to keep it as cash until you're ready for your next purchase. If the rates were to stay the exact same over the next 6 months, that means that you would have actually earned over $248, where if it were 1 month, you would have earned $41, or if you only had it in the core position for 3 days, you would have made $4. Now, obviously Obviously, if you only had it in for 3 days, or if you had less of an amount, it wouldn't be as significant, but if you had way more, or just from doing this over time, it can add up. Now, if you know you'll have cash sitting in the account and you're worried about paying high taxes, these money market funds are not very efficient in regards to that, where if you get a municipal money market fund, for the most part, you'd be exempt from state and federal income taxes, and all you have to do is buy or sell it like a mutual fund, because unfortunately, you can't have it as a core position. So if you are planning to do this, be aware that you're not going to get instant access to your cash, because with a mutual fund, in order to buy or sell it, the trade does not go through until the end of the market day. It's not as quick like an ETF or regular stock, and especially not like a core position like SPACs. If you are curious to look into these more, here are the options you can choose from, but the only thing I'll say about this is that you're not going to get as high of a yield as you'd think. But another option, if you are in a state with high income taxes that you actually might be interested in because you can still get a great yield from it, would be the Fidelity Treasury Only Money Market Fund, ticker FDLXX, because majority of its interest earned is exempt from state taxes, which the current yield is 4.93%, which would be much more beneficial for you than other municipal money market funds, but you're still going to have to buy and sell it like a mutual fund, so it's not ideal. But depending on the amount you have and what state you're in, that could save you a lot of money, so just be aware of that, do more research, and let me know in the comment section below if you have any questions at all, because we can try to figure this out together. Alright, so now that you have a good understanding of money market funds as a whole, let's now go on to covering Fidelity's core money market funds in more detail. So Fidelity has a few options you can use for their core money market funds, and if you're interested to change, you could, but my favorite and what I use is SPACs. So to start it off, with a taxable account, you'll be able to use SPACs or FZFXX. And then for retirement accounts, it will be SPACs or FDRXX. And then with any tax advantage health savings accounts, it will only be FDRXX. If you're curious, I have SPACs as my core position for my taxable and Roth account. And just so you understand the differences between each of these briefly, with SPACs, it is a government money market fund that invests in high quality, short-term US debt securities that has at least 80% of the fund's assets in US government securities and repurchase agreements. The reason these funds are not good for building wealth long-term is because since it was created in 1990, including all fees and taxes, it generated a 1.65% yield, where if I told you any statistic about investing into the S&P 500, it wouldn't even be a question. But at least for right now, the nice thing with SPACs is that you can currently yield a 4.96%. And then looking at the other options, we have FZFXX, which is a Fidelity Treasury money market fund that focuses on US Treasury securities like Treasury bills, notes, and other obligations backed by the US government. The yield you can currently get on this one is a 4.94%, which is similar to SPACs, and it's not that big of a difference. Then the other option in that retirement account would be FDRXX, which is a Fidelity Government Cash Reserves Fund that invests in US government securities like Treasury bills, notes, and other obligations by the US government. The current yield for this money market fund is a 4.98%, which isn't that big of a difference, and it's super simple to just keep everything with SPACs, but if you want to change it, I'm going to show you later in the video how. Besides that, the other options that you actually could choose, but you're probably not going to want to, or at least I wouldn't suggest that, is to look into Fcash for taxable accounts, and then FDIC insured deposit sweep programs for both the tax advantaged accounts. I don't recommend it because the rates you can get are much lower. Where you can see the previous update on Fidelity's website was July 31st of 2023, where the interest rates for Fcash was 2.69%, and that's actually going to be the same for the FDIC insured deposit sweep program, which is obviously going to be much lower than a money market fund and is why I don't even consider these options. And just so you know, for everything listed besides the FDIC insured program, the other options are all protected through the SIPC, which is the Securities Investor Protection Corporation that protects stocks, bonds, and other securities in the case that the brokerage firm were to go bankrupt and the assets are somehow missing. Fortunately, Fidelity is known as the old school brokerage firm that has been around for a long time, but if you are curious, the SIPC will cover up to $500,000 per customer, including up to $250,000 for cash held in a brokerage account. So for the core money market funds, for your convenience, here's a list of all the yields you can earn with each one. As of the recording of this video, like I said, they will change in the future, so just be aware and do your own research. But of the core positions you can choose, keeping it simple and just having SPACs as the core position, in my opinion, is the best way to go. If you do have a lot in the core position that you're worried about the high taxes, you could consider just getting another money market fund that would be better tax efficient. And while I'm mentioning it, if you do not have your savings in a separate account, like a high yield savings account for an emergency fund and other savings categories, I highly recommend you check out my content I'll have linked in the description below. then you could really benefit from it. With that said, if you do want to change your core position, here's a quick overview on how you can actually do that. Now, as you can see from this page on my traditional taxable account, when you click on specific core position that's in your account, it will show you all the details where mine is SPACs. When you click on change position, it gives you the option to select a new core position that would be for this taxable account FZFXX or FCash. And just to show you with my Roth IRA, it says SPACs, FDRXX, or you can see the FDIC insured program. But back to the taxable account with FZFXX, your cash is invested in a mutual fund and earns daily dividends which are paid to you monthly. Where FCash is when your cash is held at Fidelity as a free credit balance and earns daily interest which is paid to you monthly as well. The process to change this is as simple as clicking on the new core position and submitting the order for the change. So that's as simple as it's going to get for changing the core position, but don't forget, if you are worried about the taxes, you're going to have to look into other money market funds that are more tax efficient, but you're going to have to actually purchase and sell them like a traditional mutual fund. The last thing I want to point out, but if you're already on Fidelity, this isn't going to make that big of a difference, but you are going to be earning slightly lower of an interest compared to Fidelity's competitors. For example, Vanguard's core position VMFXX currently has a 5.27% yield, where Charles Schwab's SNVXX also has a 5.04% yield. Now, obviously that's not a huge difference, and it's not something I'd worry about because you're not going to be having all your money sitting in the core position. You really need to be investing it. I made a video on the top investing mistakes you need to avoid. I highly recommend you check that out, as well as the high yield savings accounts videos, because you can't just have your savings here. You need to have an actual high yield savings account to categorize your savings ideas. Which I will mention, if you do not have one and you are interested, you could sign up on SoFi, which is the one I use, and you can actually get up to a $325 cash bonus when you sign up and make your first direct deposit. With that said, let's now go over the final things you need to be aware of. Now, the good news is that money market funds are pretty liquid because they are a mutual fund, but it gets even better if you have it as your core position because it is instant access to your cash. But what you do need to be aware of is that with the core positions, you're not going to be exempt from as many taxes like you would with a municipal money market fund or even a higher state tax exempt option like FDLXX. Don't forget that all money market funds are considered to be investments, so you're not guaranteed to make any money over a specific period of time. Because of that, they are not meant for building long-term wealth, but are more so an opportunity for you to sustain value on your uninvested cash. Now, if you found value in this content, check out my other relevant videos. I'll have linked in the description below, as well as any of my free learning guides where you can learn more about 3-fund portfolios, savings accounts, investing altogether, or even the Sapphire credit card tool that I've created completely free for you. Which I will mention, if you are interested to invest on more than just Fidelity, you can get over $60 worth of free stock and deposit any amount on Webull if you use the link in the description below. And if you're interested, you could also check out the high yield savings account SoFi to get up to a $325 cash bonus. So as always, don't forget to hit the like, subscribe, and notifications button for future content like this.